Okay guys, so welcome back. We're now on Forex Scalping video part 5. Today we're going to be looking at risk management. Um, in the last video we did candle structure or understanding candles, sorry, and then the video before that we did understanding the actual structure, the market structure itself, and using that to paint a picture of what's actually happening. Previous to that we did some basic concepts that were important for you to understand before we progress forwards. So if you haven't watched them already, I recommend going and have a look at them. But today, yeah, we're going to look at risk management. So we're going to talk about some of the important things you need to consider. Remember, this series is to help you gain a comprehensive understanding of all the concepts and ideas you need to be able to be successful in this kind of business. Okay. So what we're going to look at first is why do we need risk management? Okay, so a lot of people will join into the market straight away. They'll start taking trades, positions, and they'll soon realize that I'd say 90% of the time things are going to end badly because I'm sure you've all heard the fact that 90% of traders lose money. Now, risk management is important in order to keep you from becoming that 90% and hopefully become that 10% of successful traders, because it's not easy to stay in that 10%. It requires a lot of discipline, and hopefully with this video it's going to help you be a little bit more knowledgeable on how to do so. Okay. So, first point I've got up here is you need to know the cost of doing business within the market. So imagine you're running a business, maybe you're going to buy some products and you're going to sell something, or you're going to buy a car and sell it. There's going to be that initial investment, or there's going to be that risk factor. So imagine you buy a car for $500 or £500 with the aim to sell it. You don't know if that car is going to sell for that price. You don't know if the car is going to be 100% okay. Maybe it's broken, maybe it's mechanically faulty. Okay, so imagine in trading, before you take any trade, you're going to know the cost of taking part in that particular trade. Okay, so that's going to be a predetermined factor of your trading plan. You're going to know, for example, if you enter this trade, you're going to potentially risk $100 or £100. Okay. Now we also need risk management because we need to remain emotionless throughout the trade. So by employing risk management, you're going to have a defined winning situation. So you're going to know I'm going to make £50, and you're also going to define the losing situation. So you're going to have both scenarios planned out, so you know exactly what's going to happen. There's going to be no element of surprise. Price can either go one way or the other. So you're either going to win this X amount or you're going to lose this X amount. Okay. So this enables you to enter the trade based on your strategy or your trading plan, and you already know exactly what one of the outcome is going to be either way, whether it be a loss or a win, but that number is going to be defined. Okay. You also need it to enable long-term survivability. So if you start trading, say £1,000 account, and you start risking £250 per trade, you lose 4 trades and your account's gone. Okay. Now that's bad risk management. Sure, maybe you consider it risk management, that's 25% risk per trade, but that's bad risk management. What we're going to do here is try and emphasize good risk management. So maybe risking 1% a trade, okay? That's just an example for now. And it also provides structure to a somewhat chaotic environment. So the markets are obviously going to be difficult to survive in, as we know from the winning percentage of traders overall, so 90% of traders lose, so it's obviously chaotic. There's obviously something there that's causing problems. And by employing good risk management, you're going to ensure that there's a little bit of structure that you follow, some set rules that make sure you know exactly what's happening, or you know exactly when your trade's finished, why it's finished, or just a way of getting you out without you just being stuck at a loose end, just falling further into drawdown or negative profits. Okay. So, what's the main controller of risk management? So, a lot of people who've seen the last video, we talked about stop losses. Hopefully by this point you should understand what they are. If you don't, it's essentially just an area that you're going to look at and say, well, if price goes beyond this level, my trade is no longer valid. Okay. So if you're if you're taking a sell on the 30-minute and you've just entered on a 30-minute bearish candle, if price moves above that 30-minute bearish candle, you're going to say, okay, my trade is no longer valid because the high of the 30-minute candle has been broken, so now it's made a new higher high, and it's essentially saying that trade's now invalidated, so we should get out. Okay, so that's going to be stop loss for there. Now, like I just said, your stop loss ideally is going to be above or below a 30-minute or 1 hour candle, depending on whether you're buying or selling. So if you're buying, your stop loss is going to be below the candle, or if you're selling, it's going to be above the candle. Okay, so that should be every single time you take a trade. You want to pick the candle, or at least pick a suitable or appropriate candle. We're going to look at an example in a minute, in which you can place your stop loss above or below, which will essentially act as a rule saying if that level gets broken, you should be out of the trade, and that shouldn't be a problem. You should accept that as a loss. You should know that that means your trade has now been invalidated, so it's no longer working. Okay. Now this is important to remember. Your stop loss will always decide your position size. Okay, so you're not going to have a set position size in the market. You're not going to have, say, okay, I trade one lot every time. If your stop loss is 15 pips, it's obviously going to be a smaller position size than if you was trading a position which was only 10 pips. Okay, so if you've got a smaller stop loss, your position size is going to be greater to balance out the same risk percentage. Okay, so let's just put this a little bit into context. Okay, so imagine we've got this zone here which I've got marked up. This is I believe Euro JPY 30-minute, but it doesn't matter, the chart doesn't matter. Okay, now we've got this zone that we marked up here. We had price moving, so it had come down, obviously it's made this low here, it's moved up and it's tapped into this zone, which I think this was some sort of resistance here. Okay, and remember we've got this low, so ideally what we were looking at from previous videos is when price makes this low, we're looking for potential areas in which we can take a sell to come and retest this low. Okay, so price has moved up, it's rejected this level, price has now printed this bearish candle here. Okay, and the candle's made a lower high compared to this one, and it's also made a lower low. Okay, so if you're taking a sell on this after this candle, so maybe you've waited for it to push up and entered like here, if you're taking a sell, the stop loss should be above this high, because if price goes above this high, that essentially means that, well, now it's made a new higher high, so the chances of it continuing bearish, continuing down is slim. Okay, so this is exactly what this is showing. So we enter here, the stop loss goes above this level, and although this next candle printed bullish, it didn't exceed this high, but it also created a lower low. Now the next one moved up, still didn't exceed this high. Okay, so this was the initial candle that would give an entry. This one wouldn't, because this was too weak, this is too small compared to these, and it also didn't create a lower low, so we wouldn't take that one. We get this one, this is a nice rejection, the first strong 30-minute bearish candle, and then we move down. Okay, now it's say if price did move up there, you should accept that as a loss, because now that's now made a higher high, and that's not criteria for a downwards move. Okay, so let's look at the opposite way around. Another example, sorry. Okay, so this one taking into structure into account. So we've got this high here, we've got this lower high, and we've got this next lower high. Okay, and then here we've got a low and a lower low. So now we've created this lower low, so naturally what we do is we wait for candles to move up, form some sort of resistance to continue down. Okay, so again we moved up here. This is not a good entry candle, because yes, it's bearish, but it didn't create a lower low. Okay, and it also closed bearish with no lower wick. So remembering what we learned from the last video, that's got no range for the next one to move into, so we wouldn't take that one. Okay, now we move up and we start forming more bearish candles. Okay, now this one's too weak, this one's got a little lower wick, but now notice this is forming a high, a lower high, another lower high, and this is forming a low, a lower low. Okay, and it's after this candle here, so this one closed bearish, quite a strong one in comparison to the previous ones, created a lower high and a lower low, of course, and it also has a range for the next one to move into. So if you could wait for a pullback slightly up here to take an entry, you could take a sell to target this area down here, and your stop loss would be above this candle's high here, because if these ones are all making low highs, so this one's a high, a lower high, a lower high. Now for that to continue moving down, the criteria is that this price should stay below the high of this one. If it goes above this, this now is no longer valid, so we shouldn't be taking sells anymore, okay? But it did, so this would have worked perfectly. So hopefully that makes more sense and that gives you a little bit of context behind that. Okay. Now, there's some numbers you should be defining every week or every day, or at least putting them into your trading plan so you can read them each day. Okay? So you need to understand, or at least know, what you're willing to, or what you're comfortable with losing in a day or a week. So if you've got a £500 account, or 5,000 or whatever, are you willing to risk 10% of that £500 in a day? Okay, so 10% of 500 is going to be £50. Are you willing to lose £50 of that 500 in a day? The likely answer to that is no, because that means that's relatively quite a large fraction of your £500 that you're losing. Now in a week, maybe that's more suitable because you've traded for 5 days, 10%, maybe you're happy with that. I personally would not be, but I'm just saying as an example. Ideally, in a day, you want to look at maybe 1 to 2% maximum risk. That's what I recommend, okay? That's what I stick with. So 1 to 2% maximum in a day is suitable. In a week, obviously, if you're doing 1 to 2% a day, that's maybe 5 to 10% a week, okay? You also need to know how much you're willing to risk on a trade to see if it will win or not. So in any trade you take, there's a probability involved. So there's the probability of winning and the probability of losing. With the trading strategy you employ, you should have the probability of winning in your favor, okay? So that's called an edge. So the chances of you winning the trade should be higher than that of you losing if you've got a strategy that's back tested and is shown to work, okay? So maybe you've got a 60% win rate with that particular strategy. Now for that each trade, you need to think of it as whatever your risk is defined as, so maybe you're willing to risk 1% on that particular trade, that is the cost of finding out the outcome of that trade. So you're risking 1% of your account to see, is this trade going to work or not? Imagine it's like a fee to do business. Imagine you need to potentially risk $100 or £100 to see if this trade's going to win or not. So imagine it's just an expense in the market, okay? Now this should be implemented into your trading plan. This should be written down clearly, saying in a day you're going to risk, say, 2% or 1%, and in a week you're going to risk no more than 5 or 10% or whatever you want to say it as, okay? Now if in a day you hit your 1 to 2% maximum risk and you take a 2% loss, that should be it for the day. No more trading, okay? You need to stick by that, because for this to work, you can't be inconsistent between the days. You need to stay doing the same thing over and over again, and the repetitiveness of what you're doing will eventually structure together to bring you a successful journey as such, okay? So everything needs to be stuck to, strict rules, discipline, and that's how you're going to eventually come together to become a successful trader, okay? So last point on this side, it helps with your mindset. So if you're risking 1% per day, that means you can lose for 100 days, okay? So imagine you don't change your position size and you stick with whatever. So imagine you start with £1,000 account and you risk 1% for every day. That's £10, okay? So imagine you'd stick with that £10 risk every single trade or every single day. That means you can potentially lose for 100 days at £10 before your account's empty, okay? Now, what's the likeliness of you losing 100 days in a row? If we've learned a strategy before which has got more than a 50% win percentage over a large sample size, 100 losing days is quite unlikely, okay? Now, whereas if you're risking 25% per day, this is an extreme example, you could only lose 4 days in a row and you're done. Your account's empty, you've now finished, okay? So this helps with your mindset. So this helps you to stop worrying about having a losing day. So if you lose for one particular day, don't worry about it, because there's always tomorrow. 1% loss in a day is nothing if you look at it at how many potential trades you can take before your account's empty. You shouldn't be scared that you've had a losing day, Okay, use it as an opportunity to learn, reflect on, and then come back the next day. Okay, so moving on. Right, let's say we're going to look at evaluating the risk of a particular trade. So every single trade is going to have a dynamic risk. There's going to be different factors that are affecting how much risk is involved, or how likely it is to win or lose. Okay, so the first thing, what I find important is your trade in the direction of the overall structure trend? If it is, that's great. You've got a higher probability. So there's less risk involved. There's a higher probability of your trade working out because you're trading with the higher time frame momentum and higher time frame structure. If you're trading against a trend, that can be fine in some situations, but consider reducing your risk. Maybe instead of doing 1% or 2% risk for a trade, maybe do 0.5%. Okay, so you need to put yourself in a situation which is best for you. So if you're trading in a more risky situation, you should probably reduce your risk so that the effects of this risky situation aren't as catastrophic if it goes wrong. Okay, so what else? Is your trade during a time of volume? Well, if it's yes, so imagine you're trading a British pound pair. Are you trading in London session? That's the ideal situation. Or are you trading a US dollar pair in the London session? Because that's not really a good idea. I really don't recommend doing that because the likeliness of it moving is quite slim, so you're going to be sat in trades for a long time, and that's when you start getting doubt. And when you start getting doubt, you start closing things early, or you start making bad decisions. Okay, so you need to check: is the pair you're trading, is it the time for that particular pair? Okay. You also need to be aware of any economic news for that day. So, is there an NFP? Is there interest rate decisions on the particular pair you're trading? If there is, well, okay, so how can you deal with that? So maybe you want to reduce your risk again. So instead of risking 1% on that trade, risk 0.5%. But in general, what I'd advise is if there's large or high impact economic news for that particular day, you don't want to trade at all. You want to stay away from it, or at least wait for it to finish and the markets to settle again. Okay. Now, last point on this one: has price already reached an area of interest? So imagine you're in a sell and the price is moving down, and then you look left and it's now at an area where price has previously bounced from. Okay, even if it's on a 15-minute chart. So imagine you're looking at 30-minute initially and you see your target's quite far down, but then you look at the 50-minute chart and you see, okay, there's quite a lot of traffic here, or congestion, or range in motion. So maybe at this point you could set your stop loss to break even, so risk free, or you could take partial profits or full profits, or you need to evaluate these different areas and be aware. Be aware what's happening currently, and just think, okay, how can I put myself in the best position? The best thing you could possibly do, in my opinion, is take a small amount of profit, so maybe 25% of your overall position, and set it to risk free. So that means the big target is still open. You've got the majority of your open position going for the big target, but you've also secured a small amount of profit, and you've also set it risk free, so you can't come out of that trade with a loss. You can only come out with this small profit now. Okay, so let's look at a few examples of this. So looking at the direction of the overall structure, this is a simple one. So this is the Euro US dollar daily chart. I don't trade this pair, but this was just printed in nice structure, so I thought I'd show you this one. So we've got a high, a lower high, another lower high. We've also got a low, a lower low, and a lower low. Okay, so that, from our first, second, third video, understanding structure, shows that overall picture we're in a downtrend. Okay, so maybe in your trading plan you'll set a dynamic risk, saying, okay, if my trade's in the direction of the overall trend on the daily chart, my risk per trade can be 1 or 2%. Okay, so if you're taking sells on this particular pair during this overall downtrend, your risk can be 1 or 2%. But for example, if you're taking buys, which is obviously against this overall downwards trend, maybe reduce your risk to 0.5%. Okay, so because when you put yourself in these kind of risky situations, you want to reduce your monetary risk. So you want to reduce the amount of money you're actually risking or putting on the table. Okay, so that just makes things a little bit smoother, and you don't have to worry as much. So that's a simple one. Okay, times of volume. Okay, so now this is the Euro JPY 30-minute chart. I've just marked on 2 boxes here. For anyone who's new to trading, this is something I actually used to do. So I draw on a box around the the sessions. Okay, so this here is London Open, and this is the London Close. So this is 8 a.m. Greenwich Mean Time, and this is 4 p.m. Greenwich Mean Time. So I drew a box around these. Even if these candles hadn't printed yet, it just means that visually I could see whatever price was trading within this area, it's my session to be trading, okay? But here marks the London Close, and all the way through here, okay, you can see the size of the candles is relatively small. So look at all these candles, these are all small, they don't move very far, and overall they're moving sideways. So as soon as London Open occurs, so this is when the London session opens, and don't forget we're trading a euro pair, look at the size of the candles and look how much volume's behind them and momentum. So we get this quick move down, and we also get a nice push up, and then again another push down. So you need to be aware of, if you're trading say a euro pair or a British pound pair, are you in this box? Are you in the London session? Or maybe you're in the Asian session. I mean, this is partially Asian session, but in general, there's never as much volume as there is in the London, okay? So sure, you can trade this, but you need to put it in your trading plan, what session you're trading. And maybe if you're trading in the Asian session, again, you can reduce your risk to say 0.5% or 1% rather than 2%. Whereas in here, you know that you've got the volume behind you because you're in the correct session. So your risk can be maybe 2% or 1% again. Okay, so hopefully that makes sense. It's a nice simple one again. Now, economic news events. This is an example from today. This was the US dollar NFP, so non-farm payroll. I don't know too much about fundamentals, so I'm not going to try and explain it. But all I know is for me today, based on my trading plan, I wasn't trading a US dollar pair, or for instance, even GBP or GBP JPY or Euro JPY while this was about to occur. Okay, I looked for trades after, but there was nothing. Okay. Now the reason why is it doesn't matter which. So price was here. This is when NFP occurred, so the data release occurred. It doesn't matter which way you was trading here. You couldn't have possibly won. Okay, so even if you saw this as a support here, and you thought, okay, I'll take a buy, expecting NFP to push gold up. So don't forget this is gold chart. It doesn't matter where you put your stop loss here, you was going to get stopped out. Okay, so if you took a buy here, which is not a good idea anyway because this candle is bearish. Even if you put your your stop loss below here, you'd have got stopped out by this. If you'd put it below here, which is the previous support zone, you'd have got stopped out. And even if you go all the way down here, you'd got stopped out. Now in the same direction, if you wanted to take a sell here, even when price broke here, okay, now this came all the way down, and this is because of the nature of the events like this. There's whipsawing, so price moves so fast in different directions. It came all the way down here. Some poor sellers will have been taking sell, 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 and then it just shot straight back up. So even if your stop loss was above here, you'd have got stopped out. So as much as people can trade these kind of things with buy stops and sell stops, I'm not going to go into that because it doesn't matter. If you want to know what it is, just Google buy stops and sell stops. You'll find enough information. But people can trade this kind of thing. In terms of risk and staying in the best situation possible with the least risk, don't trade when there's economic news events like this, because this will screw you over. This will ruin your account, I promise. Okay. But if you want to find any news events like this, if you don't know already, you can use a Forex Factory. So that's called Forex Factory, or the one I use, which is predominantly used in the UK, is investing.com. Either one of them, economic calendar, they'll tell you the news events for the day. Okay, so moving on. Oh yeah, okay, so has price reached an area of interest? So this is a trade, if you follow me on Instagram, you'll have seen I had this long trade in it, this short trade in from yesterday or the day before. I took an entry up here, so this was my resistance zone, and this resistance actually extends over here initially. It was based on these wicks and moves away from this area, okay, all this rejection. This wick occurred, and then when this moved up here, I then took another sell, and my stop loss was actually above this area. Okay, so when the price started moving down in my direction, I was considering areas of interest. So as it's moving down, I'm looking left, I see this zone here, and then it moves further down, and I look at this zone here, all this area, okay, and then it moves further down, and there's this area, and then it moves further down, and this area, and then it goes down, and here this was another area. Okay, so what I'm trying to emphasize here is, even though I took a sell up here and I'd been posting this progress on my Instagram story, I was not in the same position size down here as I was when I was up here. Okay, so as price kept moving down to these levels, I took some profit. When it got to here, I took some more profit. When it got to here, I took some more profit, and to here, more profit, till eventually I had a really small size running. Okay, so that's considering areas of interest and evaluating it and managing your trade accordingly. Okay, so also I should say my stop loss when it got down here was risk free, so I had this pulled down to here and I couldn't lose anything then, and at this point I already took some profit, and then like I said again, I took profit at each of these levels. So that's how you can evaluate areas of interest, looking left and saying, okay, should I put my stop loss to break even? Should I take partial profits? Or you could even close full amounts. So at this point here, looking at this here, this bounce and this bounce and this bounce, this is probably a good area to take full profits. Okay, but it's just that I'd already taken profit, and I was willing to risk this profit now with my stop loss at break even to see if this would continue down, because based on higher time frames I had a target which was down here. Okay, so hopefully that one makes sense. So key things to remember from this video. I know there's been a lot of different things in it, it's not been stuck to one kind of idea, but I feel like the things I've talked about are quite important. You need to understand them and memorize them, get them written down or wrote down. But okay, so key things to remember. Before every trade, you should know how much it is going to potentially cost you to take part. So that's like we said before, so it's the cost of doing business. So at the beginning of each trade, say if you want to take a sell on Euro JPY, you need to know, okay, this trade is going to cost me £25 to find out the outcome, okay, potentially. If it doesn't work out, it's going to cost you £25, so you need to have that in your brain. You need to have already almost accepted that loss in the back of your brain before you even start, okay? So by doing that, that's going to be a much better position for you, okay? So you're not going to be worrying about it, you're not going to be, there's no element of like, what if, or, oh, I wonder how much I'm going to lose, okay? So, next, always stick to maximum daily and weekly risks. If you set a daily risk of 2% maximum, when you hit that 2% maximum, you need to stop trading. Really, you need to stop trading. Do not take another single trade, because then you're just breaking your rule. And if you break one rule from your trading plan, well, what's to say you're not going to break another rule? And then by the end of it, your trading plan becomes pointless, useless, and just sat in the corner gathering dust. Okay. Same with weekly. If you've got a weekly max risk of 10%, you need to stop at that 10%. If you stop moving over that 10%, where does it actually stop? Where's that 10% move to? Does it go to 15%, 20%, 30%? You just find yourself spiraling into almost a black hole. Okay. Now you also always need to open up an economic calendar for the day and see, is there any high impact news on the pairs that you plan on trading. Okay, so like I said before, Forex Factory or investing.com. Next one, do not alter your stop loss. Your stop loss acts as a rule and don't break it. This is important. Get this one like noted down, okay? So if you set a stop loss which is above the high of a 30-minute bearish candle, once you're in that trade, you don't move that stop loss just because you think, oh, well, it still looks pretty good, maybe it can come down. Do not move that stop loss, because you can't start adjusting these things, because it's the long-term run of these strict rules that are going to give you the edge in the market, and you need to be consistent for the edge to play out. If you start moving your stop loss and moving it up a little bit more, so you're allowing that candle's high to get broken, then you've just broke a rule in your trading plan, and your trading plan is no longer strict and it's no longer consistent with any previous trades you've taken. Okay, so remember that. Do not move your stop loss. If it hits your stop loss, that's great. That means you've just given yourself an opportunity to learn. You've just given yourself an area of evaluation which you can go back at and say, okay, this didn't work. Why didn't it work? Zoom into different time frames, 30-minute, 50-minute, 5-minute, I don't know, doesn't matter what, and note down what you saw, what indication was given that your trade was going to start failing. Do not overtrade, okay? So if your maximum risk per trade is 1% and your daily risk is 2% maximum, if you take 2 trades, you're done. do not take any more trades. And also, I need to emphasize, if you take 2 losses, do not think that just because you've taken 2 losses, there's any kind of influence on the next trade being a win or a loss, because something I've always kept in the back of my mind is every single trade is statistically independent of the last one. Okay, so what that means is if you can have 10 losses, and just because you've got really unlucky them last 10 times, that does not mean that you're going to get lucky the next time, because the next trade does not give a flying monkeys about the previous trade. It doesn't matter whatsoever. Just because you think, oh, I've had an unlucky streak, surely the next one's going to be a win. That's not the case. If you take two losses, stop trading. Or even if you take 1 loss, maybe stop trading. You need to put this in your trading plan, but stick to it. Do not take any more trades than you've set yourself out to trade for the day. Okay. Now, final point, which basically reiterates all of them: check your trading plan. Every single thing I've talked about on this video should be in your trading plan in some form. You need to speak about it, you need to set it down with strict rules, and you need to see it clearly and read it every single morning, day, night, sleep with it under your pillow, and know exactly what it says and understand why these rules are in place. 'Cause that's where you start to follow them. If you know why this rule's here, then you'll follow it, okay? So, I believe that is the end of this video. Next time is to be confirmed yet. Like this video, this was based on viewers' comments and recommendations, what they wanted to see. Okay, so again, be messaging me on Instagram, which is down at the bottom of the page, I believe, somewhere down here, at Trade Ideas. Be sure to message me saying you've watched this video, tell me what you think. Any questions, as always, message me and ask them, I will reply. I've just had my final exam today for February. No more exams till May, I believe, so I've got more time to message you guys and answer questions, okay? But I hope you enjoyed this video. I hope you learned something from it. I must emphasize everything in this video. Again, you need to consider and put in your trading plan in some form, okay? But until next time, thank you very much for watching, as always, and I look forward to speaking to you on Instagram and in the next video. Goodbye, guys. Thank you.